Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome and hello to this episode of the FedLife podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Servantly Sipe and Associates. I am just letting you know, I know that podcasts are supposed to exist outside of time and space and dates. But it's the holiday season, and this has been a tough year. So I'm in a holiday mood. If I'm over the top today, you're going to have to bear with me. I apologize. We're still going to have good information here, but I'm amped up to get 2020 over. I'm amped up that all of our feds will have a nice holiday, that they won't do anything stupid and have a shutdown. So that's where I am, just letting you know. So as I always do, I want to thank you for taking the time to listen. And above all, thank you for your service. You don't hear it enough. You will always hear it here. Everybody forgets what feds do but us. And we will do everything we can to remind them. We are back today, continuing remotely, because that's safe, with our friend, our buddy, the guru, the incomparable Ed Zurndorfer, as part of our mission to reach, teach, and serve you. At the outset, I need to say, and this bugs me every time I say it. I know I have to do it for compliance, that the opinions of our guest Ed Zurndorfer are not the opinions of Raymond James. Well, you know what, Raymond James, they probably should be, but they are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. As usual, these podcasts will mirror Ed's FedZone articles. And let me tell you, Ed has been doing quadruple duty lately. He is everywhere. Okay, he's doing full day webinars for places in Massachusetts, and he's picking up webinars here in DC. He's got at least 10 that he does with us, and he's cranking out these articles for us and another publication. So he is really getting it done for you. In this particular one, we are heading into how Ed likes to wrap up the year with tips. And in this case, this article is covering some year-end tax moves because, as you may or may not know, in addition to being just a national treasure and an incredible resource in the topic of federal benefits, Ed is also an enrolled agent with the IRS, so he knows whereof he speaks here. So, Ed, you excited to talk taxes at the end of the year?
Oh, I'm so excited, Dan. I just look forward to this to no end because, as you mentioned, Dan, I do have a tax practice. And one thing I do not like is when my clients come in February, March, and early April and say, Ed, is there anything I can do now to save on last year's taxes?
Ooh.
That is not good planning. They have to come to me in November and December because there's still time to save on this year's taxes. And that's why I'm writing these columns this month, all dealing with how to save on 2020 taxes, some last-minute tax-saving moves.
Great, and we get them up there as fast as we can. So let's jump right in, because first up is my personal favorite, charitable deductions. I love them. Okay, I look at that, I take it off, I say, I'm not getting taxed on that. We have some additional incentive this year, kind of, because of the CARES Act. So why don't you tell us about that?
Yes, Dan. Back in March, when the COVID-19 unfortunately reared its ugly head, Congress did pass some laws making life a little bit easier for people affected by and not affected by the COVID-19. And one of the as part of the CARES Act, that is the Coronavirus Aid, Relief, and Economic Security Act, CARES Act, is that charitable contributions were made a little more liberal in the following sense. As you might know, in order to deduct qualified charitable donations, donations made to a church or to a synagogue or to a mosque or the Goodwill, things like that, one has to itemize on their federal income taxes. That is, they have to file Schedule A. Mm-hmm. If they take the standard deduction Certainly, one should always make charitable contributions, whether they get a tax benefit or not. But those people who take the standard deduction cannot deduct any type of charitable contributions because they just take the flat standard deduction rather than itemizing their deductions. Because one of the itemized deductions is charitable contributions. That being said, Congress, to make people be a little more charitable, is allowing individuals who take the standard deduction to make a up to a $300 deduction for donations made to qualified charitable organizations. Now, this donation has to be in cash or check. It cannot be in donated goods. But the $300 maximum deduction is, in fact, an adjustment to one's income, meaning that if, for example, if somebody has income of total gross income, let's say of $100,300, $100,300, and they make a $300 donation, then their adjusted gross income falls to $100,000, and that saves them some tax dollars. Only available to people who take the standard deduction. That was one thing that was passed as part of the CARES Act. The second thing that was passed as part of the CARES Act that is charitable related is that for those people who do itemize, who file Schedule A, who can include their charitable contributions, there is no limit this year. Well, I should say the limit is 100% of their adjusted gross income. If their adjusted gross income is $100,000, they could make a $100,000 donation to qualified charitable organizations, thereby wiping out their entire income. They'll owe no tax.
Gotcha.
Previously, until this year, there was a 60% of adjusted gross income limit as far as how much one could donate in cash or checks to a qualified charitable organization. But for this year, the only limit is your adjusted gross income.
Wow, that is certainly a big relaxation there. Up next in your article, you remind us there's still time to make TSP contributions. So if somebody maybe has been below max or something like that, still have a little time here. So talk about that. But let's also talk about the limits for 2021 in case somebody gets to this, after the first of the year. We want to make sure that a lot of these things are timeless. It's not a bad idea to be thinking about them earlier rather than later. So talk TSP for a minute, Ed.
Absolutely. Well, Dan, I think for most federal employees, there is still perhaps one more pay date in December. It is the middle of December now, but there might be at least one more pay date. And for 2020, a federal employee who is under the age of 50 can contribute as much as $19,500 to the TSP. And an employee over age 49 who's eligible to do catch-up contributions, such an individual over age 49, as of the last day of 2020, can contribute a maximum of $26,000. So let's suppose an employee this year, as of today, has contributed, let's say, less than $19,500. Let's make it $17,000 for $17,000. So they still have another $2,500 that they can contribute to the TSP. And they're thinking now, what will that do for me if I put that remaining $2,500 into the traditional TSP? The traditional TSP is the TSP account in which the contributions are deducted from one's gross salary, not after-tax gross salary. So in essence, Dan, what this means is that $2,500 contribution to the traditional TSP will result in a $2,500 deduction. So put in dollar terms, if the employee, let's say, is in a 22% federal tax bracket, let's say, I'm doing some math here, I'm going to take 22% of $2,500, and that comes out to be $550 of federal tax. That means that employee, by making that $2,500 contribution to his or her traditional TSP account, will save $550 of federal tax. And in most states around here, I know for a fact, all the states around here have state income taxes.
Yep.
So let's say in my home state, your home state, Dan, of Maryland,
Yep.
which has an 8% maximum tax bracket, marginal tax bracket, that $2,500 contribution will result in another $200 of state income tax savings. Think about
Gotcha.
this. You're getting tax savings, not to mention that money is going into one's traditional TSP account and is going to grow tax deferred, not be taxed. None of it will be taxed until the money is withdrawn.
Yep.
Great opportunity to save on this year's taxes, not to mention to save for your retirement.
Couldn't agree with you more. Actually, your next tip covers one of the topics we covered last month. You're saying there's still time to make HSA contributions. So take us through that quickly.
Yes, those individuals, those employees, as well as retirees who have health savings accounts. These are like flexible spending accounts for health care, but they're different. With the health savings account, one can withdraw the money from the account tax-free to pay for qualified medical, dental, and vision expenses. The money that is contributed to the HSA is an adjustment to one's income. You can voluntarily put money into your HSA, and those contributions will result in one's getting an adjustment to one's income. No matter what their income is, they get a tax deduction, an adjustment to income. For 2020, the maximum amount that can go into the HSA, if one has what's called self-only coverage, is $1,400. And if one has self and family or self plus one coverage, the maximum contribution that one can make to one's HSA is $2,800. Now, Dan, I got to point out something, though. The deadline for putting the money into your HSA and getting a tax benefit for 2020 is actually April 15, 2021. You don't have to make that contribution by December 31st.
Oh, wow.
So you do have some time. This is one of the things where, I'm looking at my taxes now. It's February, it's March, and boy, I'm going to owe a heck of a lot of money, it looks like. Well, you still have time to get some tax savings for 2020 because the deadline for funding your HSA account is, in fact, April 15, 2021.
Okay, keep that in mind, feds. Your next one is really familiar to me, may not be to some of our feds. I love the way you wrote it, though, because we have certainly seen it happen. And that is beware of open-end mutual fund payouts. I know for a fact, Ed, especially with some of the managed funds that we've encountered that people have, they've done some nasty tax things in December over the years, which is always something of an unpleasant surprise. But why don't you take folks through that beware the open-end mutual fund payouts?
Yeah, I call it beware of buying. It's called buying a dividend. Buying a dividend, that's the technical term. What this is all about, Dan, is if one owns a mutual fund outside of a retirement account. We're not talking about an IRA here or the TSP. We're talking about you invest in it's called an open-ended, or more commonly called a mutual fund.
Yep.
Well, mutual funds, which are nothing more than a collection of stocks or maybe a collection of bonds or a collection of stocks and bonds, one of the rules for open-ended funds is they must pay out, in the case of stock funds, I believe it's at least 90% of their earnings. They have to pay it out to their shareholders by the end of the year. Also, some of them actually wait till January to pay it out. But here's the point. That those dividends, those capital gains are taxable. And many mutual fund owners are not aware of this because they figure, well, the fund went up in value the year I did very well. I don't have to worry about taxes. I didn't sell anything. When in fact there is going to be a payout in December, sometimes in January, but the shareholder will be taxed on the dividend and the capital gain payout on this year's taxes. It can cause a real whammy because one is not expecting this.
Sure.
And the best thing to do is to ask your fund, the fund of management, when they plan to have a payout, because that is advertised. It's called the pay date,
Yep.
and one can plan accordingly. The reason I say that is because, Dan, if in fact the payout is going to be for this year, and one has not planned for that, and there could be a significant payout. The market has done very well this year. The funds are holding a lot of earnings, dividends, and capital gains. They pay them out. One could face a significant tax liability as a result. And in that case, I advise strongly they talk to their tax advisor. I'm in my tax practice, I have several clients who contact me at the end of December knowing that they got a payout. And what do? I suggest strongly that they pay the fourth quarter estimated tax payment to the IRS and to their state revenue department in order to not have to be subject to an under withholding penalty come next spring if they owe a lot of money on their taxes. You have to pay in during the year to make sure that you're paying enough throughout the year when it comes to your tax liability, and not wait to the very end to pay a significantly large tax bill, or else you'll be subject to what is called an under withholding penalty.
Good advice. Good advice indeed. And in this part, last but certainly not least from the article, it's one of our favorites here at Serving Those Who Serve and LSA, harvesting tax losses. But Ed, aren't losses always bad?
There could be some good that comes out of losses, Dan.
Very true.
And this is called tax loss harvesting. Yes, I know it's the fall, and we think about harvesting. What do we think about? Harvesting the crops?
Oh, absolutely.
Well, this time of year, we're going to harvest the losses.
Okay.
And what this is all about is, and I think the best way to describe this is to use the example I wrote about in the article. Let's suppose, Dan, an individual buys shares of, let's call it stock A, and the person paid $10,000 for that stock, for the shares of that stock. Well, a few months later, the market has gone down, the stock has gone down. Now the stock is worth $6,000. Ooh, that's a $4,000 loss. That hurts, doesn't it, Dan?
Ouch.
The stock owner decides, this thing is not coming back. I'm going to sell it. Sells it for $6,000, and they have a $4,000 capital loss. That's the $10,000 they bought it for, and then they sold it for $6,000. That results in a $4,000 capital loss. Ouch. Is there any good that comes out of that? Maybe, because if, on the other hand, let's suppose the same person who bought stock A has some mutual funds, and as we just described, at the end of the year, there's those payouts from those mutual funds, and let's say there's a $4,000 capital gain payout, long-term capital gain payout. Well, you know what the stock owner can do then? The owner of stock A, they can apply that $4,000 loss dollar for dollar against that $4,000 capital gain, and what will that result in? No tax. No tax. So you apply the capital loss against the capital gain. It will reduce, if not eliminate, any capital gains taxes. But suppose the person has more losses than capital gains. What happens then? Well, in that case, then the individual can apply up to $3,000 capital losses against other income. What's other income? Wages, interest income, rental income, dollar for dollar, and that will save some taxes. So some good may come out of the capital losses. I want to strongly urge people that in a case like this, if they're thinking about selling some stocks or mutual funds that have gone down in value in order to generate capital losses, please, what I call, don't let the investment tail wag the tax dog here.
Gotcha.
Because you shouldn't start selling stuff for the sake of selling stuff in order to generate tax losses to save on taxes. That's not the way to go. You have
Gotcha.
to look at your goals, your financial goals, and before you start selling something, then and you're convinced that what you're selling is, for example, is not going to come back in value, it's a true loser, then maybe talk to your tax advisor and see if it really makes a good sense to start selling stuff to generate the capital losses.
Sure. And if you work with a financial advisor, be sure to include them for where you might want to go, because you just sold it. So yes, there's a $4,000 loss, but now you're sitting with $6,000 because you need to be careful, because you can't change your mind and decide, hey, maybe that stock's not so bad, and just go ahead and buy it, because that's Ed's next topic here. Great segue, Ed, which is the wash sale rule. So why don't you talk about that?
Yes, as we've always been taught, Dan, when is the best time to buy something
when it's down.
when it comes to investment? When it's down.
When it's down.
Right? When it's down. After all, don't we do that with our everyday commodities? Don't you wait for sales, Dan?
Oh, absolutely.
Absolutely. Well, if the stock market is on sale, it's down in value, people get depressed. I think, it's a great time to buy. Because you're buying your shares of stock, your shares of the mutual fund, ETFs. If they're down in value, you're getting more for your money. And if you're patient, things will go up. So here, let's go back to the example here. Let's go back to the example here of the person who bought $10,000 worth of shares of stock A, sold it for $6,000 when it went down to $6,000 value, got a $4,000 loss, and decides, this stock is really sinking in value. And then a few weeks later, it's down in value to, let's say, $4,000. Person says, oh, I know what I'm going to do. I'm going to buy it back. This way I can have my cake and eat it too. I got my loss, and now I'm buying the same shares back on sale, and I'm going to wait this thing out so that things are going to be better, in the future. Things will go up, the market will increase, and this way I can have everything I want. I have a loss, and then I'm buying things cheaper, and then the total value of my portfolio will eventually go up. Wrong, because the IRS has a rule that if you buy the identical stock or any other security that you sold at a loss. You buy the identical stock or security or any other security, the one that you sold within 30 days before you sell it, or 30 days after. That's a 61-day period we're talking about. We're talking about 30 days before you bought it, the day you bought the day you sold it, and 30 days thereafter. That's a total of 61 days. That loss will be disallowed by the IRS. It's called a wash sale. You have to wait at least 60 days after you sell it at a loss before you can buy it back, or else the loss will be disallowed. In fact, the brokerages, when they send out their 1099s and someone has sold something and it is a wash, so they buy it back, as we just described, it'll be indicated on the 1099 that it's a wash sale, meaning that the loss is disallowed.
Yep.
Got to be careful.
Yep. Have to be careful. Folks, when you run across these things, hopefully all of you have an advisor. Hopefully all of you have an accountant. But if you find yourself stuck and you're just looking for an answer, you can always come to our website, asked@stwserve.com. You'll just get an answer. You'll get an answer. And that's out there to help you in those situations. Don't make it too complicated where it's going to take 17 hours to answer it. Okay, so play fair, but we'll do what we can to help you there. The things that you do and the stuff that you bring, it's so valuable. And I was thinking, wouldn't it be great if folks could get info like this more than just once a year at year end from you? And oh, wait, there is. It's our webinar series. Ed has not one but two webinars covering tax and financial planning, okay, and most every month. There's only so many that we can fit in with Ed's schedule and Jen Meyer's schedule and our schedule, but we will really try and keep a pretty good slate going there on a monthly basis. So if it's not happening in a month, chances are good you're going to see it in the first week or two. Ed and Jen have it all in one sock. They're doing it all through the year, so you can learn at your own pace. Take notes, ask questions, and then your benefits planning is going to get a lot easier. Don't you think so, Ed?
Absolutely. We enjoy doing these, and we could put out a lot of information. And the best part about it, Dan, you can take it as often as you want.
That is very true.
Questions along the way. It's a great opportunity for employees and annuitants to get a lot of information about various types of federal employee benefits, including tax planning and financial planning.
Yep. Couldn't agree with you more. Ed and Jen are there all year, so take advantage of it. Ed's the best. Ed and Jennifer together are dynamite, so head to STW. Head to stwserve.com, hit the red button. That's going to bring up all the webinars that are available that you can register for right now. If for some reason none of them fit, you can go on a waiting list, so we will let you know as soon as they open up. Ed, I say this every time. I don't know how you keep up with all of it, but I'm grateful that you do on behalf of the feds, and I'm super grateful that you do it with us. So, folks, that is a wrap. This is the first of 2 of our Holiday Mood podcasts. The other one will be up shortly after this one. Ed will be back as we continue to reach, teach, and serve you. We are serving those who serve. Be sure to subscribe to this podcast on your YouTube channel and Spotify. Please remember to share it with your friends, strangers, enemies, you name it. The big thing that I can tell you is anybody that you share our information with, they're going to get what they asked for and nothing more. They come to one of our webinars, they're going to get information. Okay, there's no sneaky backdoor stuff like a lot of other places do, where next thing you know, you got a sales pitch going on there. Not happening. And best of all, with the webinars, Ed comes to you. If you're working from home, Ed comes there. At the office, Ed comes there. As I said before, you can learn in your bunny slippers. Ed doesn't mind. Do you, Ed?
Absolutely not. Just come.
Yep. 8 unique webinars. They are awesome. The guru comes to you as we work to reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all, share it with your friends. They will thank you. And be sure to read Ed every month in the Fed Zone, literally every week. What am I talking about? And sometimes even more. And that is at fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, happy holidays. I know, not supposed to do that, but I did it anyway. And above all, remember, it's your Fed life. Make it a great one, because you really do deserve it. Stay well, everybody. Stay safe. Happy holidays. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.